Hello, everyone.
Hello.
Yeah, you can remove your mask. Apparently, we're allowed to do so. So we're glad that we can do so. And you have some water. So please be free to take your drinks. And thank you again for being here tonight to talk about this really strategic topic. And my first question will be for you, Roxanne. It will be why such a strategic topic around like sharing the capital with your team, and what is so important for startups maybe to share the capital? What are the arguments to attract talents? You have like thousands of startups here in your campus, and you conducted also a survey like a few weeks ago, so maybe it's a good idea like to share your input on this. So
Super.
what can you say about that?
Super, thank you so much. I think you mentioned actually some of why people should use stock option plans for their employees in your intro. So I think it's definitely a great talent acquisition and retention mechanism. Great is an underestimation, not selling it enough. I think it's an incredible way to acquire and retain talent. And I also think exactly what you said about aligning interests. I think what's really interesting is we're starting to see more and more founders, but also employees becoming aware of exactly the benefits and what it means to own options. So I think that there's definitely an education piece that needs to be worked on in the ecosystem, and I think that platforms like SeedLegals, and there's a lot of other actors that are working on kind of showing what it means and what are the best practices to put in place for founders and for employees. But I think what we're seeing is in the early stages, there's some incomprehension, it's not very tangible, and as the company scales and it grows, it becomes much more tangible. You can put a number in front of it. People start to really understand the value it vests, so a lot of great things around that. And so also just to come back to the numbers that you mentioned earlier, I think what we're seeing is definitely an early stage. There's a lot of, it's something kind of heavy to put in place, so a lot of companies put it off or they don't do it right away. But actually, we are very on target with the numbers you shared, but we did a similar survey and we said, do you plan to put one in place, an employee stock option plan? And this number actually goes way up to 91% of companies. So I think you actually have a very, very small percentage today that are not planning to use equity at all as an incentive. And I'm actually interested to know for the companies that don't want to do it, what that reason is. We didn't manage to actually find that out. But so I think today it's definitely being widely used, which is not the case from a few years ago.
Yeah, that's interesting what you say about like it's really heavy to put in place such a scheme, and this is why at SeedLegals we try to streamline the process. This is why I'm asking you, Anthony, about like we are dedicating our platform and also our work to streamline the process, and what you can see also from like the UK side of things, because we are like in the UK, we also of course in France. And what are you like comments on what Roxanne said and about the survey, and how can we maybe like demystify how we can implement this kind of scheme?
Okay, so thank you very much. So our goal at SeedLegals is to build all the legal documents to do what you want, but also importantly to give you data and knowledge to show you what to do. So if you go to a lawyer and you ask them to do X, they'll do X for you. My goal is that we will show you with data what's market standard and help you every step of the way. So taking a step back, right at the beginning of your company, you don't have any money to pay your team. So you might use share options to compensate them for the amount, the difference between what you can pay them and what they could earn on the free market. Later on, when you can pay them a market rate, you might give them some share options, some equity in your company as a motivation for them staying with the company, so that on an exit of the company or later, they can pay their house mortgage or something like that and make some benefit from it. And then, of course, the question is how much you should give them, how long should they vest over, what if they leave the company beforehand, and all of this, as Florent says, is how do you even know where to get started? So my goal is to show you what's standard and then make it easy to implement that. And we'll revisit what's standard and how to implement over the next half hour.
Exactly, and based on data and based on the platform, this is exactly what we do, and there is like many arguments maybe to attract people. Equity is one of the components to attract and a good argument, of course, to compete with big firms to attract these employees. And what you can see also, Virgile, because with figures, it's a startup focusing on benchmark and salary and so on. So you have a good understanding on what could be the arguments maybe to attract people. What is your input on this?
It's a good question. So I think, sadly, nowadays, founders can't really choose what to base their package on, right? So they can't do, we're doing just salary, we don't care about equity, we don't care about benefits. In the current markets we're in, I mean, you need to be competitive, right? The market is going crazy, mostly because of the ton of money pouring in.
War of talent, with
there's a ton of talent coming in. I mean, there's all those things, you need to be competitive, and you need to be competitive. It used to be not that long ago, it used to be you work in a startup, you're paid poorly, you have cash, you haven't heard of shares, or you've heard that those things exist, but you don't get them. And benefits seems like something from major companies have, but you just work your ass off, and maybe you've heard you have health insurance, you're not even sure, right? Yes, this is your old world. Now the new world is talent has all the leverage, right? You need to be able to attract people, and you can't attract them with packages like I just described. You need to be strong on cash, you need to be strong on equity, you need to be strong on benefits you offer, or at least have a balanced package. Maybe you're a bit lower on cash, but then you have to be strong on the benefits or equity, and potentially even culture and work conditions and all those things that play a role, right?
Remote.
But the main thing here is for founders and HR directors and so on, you have to be competitive. The market is getting very, very competitive. And if you're not serious about equity, you're going to fall behind every other company that is becoming serious about equity.
No, that's interesting because it's quite standard in a way to share equity, but what we can see with the numbers is maybe companies are too young, it's easy to implement such a scheme, and what do you think, Dominic, because you have 100 of startups at the head of talent at Index Ventures, so you're following a lot, so do you think this is quite standard to implement such schemes? What would be the best arguments, Virgile said, about for startups to attract talent and to compete, because it's about competition and how to be such attractive companies?
Yeah, thanks, Flora. We work obviously with from very early stage to late stage companies at Index, and it's great to see in Europe, and obviously we work across the US and Europe as well, so seeing a lot of that sort of Silicon Valley mindset coming across to Europe in terms of using equity to really attract and retain top people. And obviously another part of the key lesson, a key thing which we try and push, and we always see this, is the best outcomes come from assembling the best teams. If there's one constant in startup life, it's the best teams win. Best teams create the best product, best teams attract the best customers and partners, etc. So it all comes down to trying to assemble as strong a team as you can. And exactly as the other panelists have said, you're going to inevitably be short on cash relative to who you're competing against and bigger organizations. So, although it's great to see more funding coming into the environment early stage as well, so cash salaries are going up at all levels. I would say as an aside, this is the craziest comp inflation environment I've ever seen in my 15 years or whatever working in venture. It's pretty nuts at the moment. So it's a bit of an unreal world, but I think, having said that, I think this is structural. I don't think we're going to go back. I don't think we're going to have a time where salaries are going to suddenly drop like the stock market might. I think this is a structural change because there is a shift from the key bottleneck being financial capital to human capital is the key thing which is holding companies back. And then how that turns into more tactically how you should think about this as particularly as early stage founders. You're not going to be able to offer the same sort of cash comp as larger organizations. You're definitely not going to be able to offer the range of benefits. So really the two weapons you have that you can use are, one is all about culture, mission, impact, values. And I always lead with that. That's the single most important thing, is people who are going to thrive and do well in a startup environment in early stage companies are going to be the type of people who hunger for those things. They want a strong mission. They want a positive culture. They want to be really impactful in what they're doing. So that's always the thing to lead on. But the equity aspect is the other, right? When you're very early stage, you can potentially look at huge upside. So it's when your equity is most valuable, is in those really early stages. So really leveraging that is absolutely critical. And just to try and, I'll use a real example from a candidate and company I was working with, and we just closed somebody last week, right? This is like right at the top end, okay, of ambition, but it's a seed stage company. They're actually two semi-technical but not super technical founders, but very credible. So they wanted to bring in a technical, not co-founder, because they were seed funded, so they weren't going to say a co-founder, but somebody effectively a CTO. And just to tell you those trade-offs, this was an individual we managed to bring in from our network who was earning 230,000 euros as a base with a 20% bonus on top at a late-stage pre-IPO fintech company. So he joined, been there for a few years, but his equity was worth something, but it wasn't the big decider. So it was, how on earth are we going to convince this person to join a pre-revenue early-stage company? How are we going to land this person? So I'm just trying to be very specific here. The deal we landed on, and obviously, yes, they've been backed by Index, so this is a seed company who have like 5 million euros in the war chest. But he accepted. He absolutely loved the vision, loved the mission, loved the other founders. So was really keen to join, was ready and desperate to join something early stage for all the reasons I said. So the offer we went with was 145,000 as a cash salary, no bonus, and we actually did a unusual equity scheme because on the basis that this is somebody, he was an engineering director level, so he's running teams of like 50 people, 60 people already. He can carry that company through as a CTO for a long period of time. So we constructed a 6-year vesting period with 6% equity, right? So it was like one of the most enormous equity packages I've been involved in for a non-founder, but 1% per year vesting. So it sort of shows the type of shape, and he accepted on that. There was a lot of negotiation, but he was bought into the mission. So you can see he dropped his salary by about 35%, still on a solid salary. He had family, etc. So he wouldn't drop below that. But he gave up his bonus, he gave up all the corporate benefits, but for a very large equity award. And this individual started a week ago. He started like the day after he signed, and he's already having an incredible impact. And I've talked for so long, so I'm going to shut up.
That's really interesting
But
because
just to try and put real numbers in.
This is a concrete example about the cuts and negotiation you can have with a startup. So for a seed company, so 6% can mean like, okay, this is big if you were working.
That's insane, right? As I said, that's really
that's really big because if we compare with the figures we have with our surveys, like usually startups like they have 5 to 10% for all employees. And this is interesting to have your point on that, Anthony, because if you have this case Dominic was mentioning, is like, okay, you have to hire like really key people, but you also have to split the capital and to share the capital with all the team. So how can you do so based on the data we have on the platform? What would be like the good argument to use to attract these people with the cut they can have and then salary and so on? So what would you think on these points?
All right, so great question. How many options should you give someone? Over how long should they vest? And what happens if they leave the company next year or before an exit? So the first thing with share options is a bit like salary. If you don't pay your developer their entire annual salary on January the 1st, you pay them month by month. And likewise, when you give someone share options, you give a number up front, but they only really get them if they stay with the company for some period. And we've seen from the survey that 4 years is the typical period. So each year, a few more of them vest, or each month, a few more of them vest. So if they leave after 2 years, they keep half of these options you've offered them, and they have to give, or they lose the other half. But that's the vesting scheme. But you can also make it a higher stakes game of poker. And you can say you only get anything if you're with us until the exit of our company. If you're just with us for the next year and you then disappear, we want you to be with us till we reach the moon. And that's called an exit-only scheme. And it means if you leave before the company is sold, you get nothing. And if you're there until the company's sold, then you get potentially all of your options. So I think that model works well if the person's getting paid market rate. If they're a CTO or tech lead that Dominic mentioned was giving up 120,000 euros a year salary for several years, it wouldn't make sense for them that if they left somewhere in the next 6 years, they lost all of that. But if they were paid market rate and there was a nice bonus, and you could say, because not everyone will be with the company until an exit, for those who are, I can give you twice as much as I would have given you otherwise because some people will go. So you might think about this as a sort of a gamified way of working. Then the next thing is how many to give. And when you start your business, the founders between them have 100%. They have all of the shares. They've got 100%. So let's say they're two founders, 50% each. And maybe now on a weekend you get a CTO and you may give them 5% equity. But later on, when you've got 50 or 100 or 200 people in the company, people might be getting 0.1% or 0.01% each, because otherwise you'd run out of capital too quickly. So if you now hire someone and you say, congratulations, sir, you're getting 0.01% equity, it doesn't sound very exciting. So you want to find a different way of expressing it. And so later stage, you might say, I'm going to give you 50,000 euros in equity, or 1x your salary in equity, vesting over some period. So people go, it's got some value, rather than a meaningless number of 12,000 options, or 0.1% and so on. So it's all about the establishing value for the employee, but of course being able to spread it, not just over your team now, but thinking ahead later.
And this is really a good example you mentioned, Dominic, and this is also a good example too, to explain what would be the vesting, and it's based on, of course, on the long term, rather than salary, could be really short term, and but it is something really, really important for startups to have this in mind, because it's a really good argument to attract people. But as you said, Roxanne, with your survey, there is a gap between maybe the understanding about, okay, the question was would you like to implement an ESOP scheme for founders? And most of them were not really. And so maybe there is a gap between the understanding of such important tool to attract people and why they won't think about implementing that today. How would you explain that maybe because there's other benefit in France, so it's okay, you work, you have health insurance, this is mandatory, so it's something we can see in the UK, which is not, so companies can also compete on this front. So how would you explain, maybe, it's maybe a tough question, but...
How would I explain why people would not put in a stock option plan? I actually think it might be with regards to the employees. I think if you ask employees, I'm going to characterize this really badly, but would you prefer ticket resto, restaurant tickets, lunch credits, or would you rather have options? Actually, the ticket resto is such a basic, essential, maybe they actually prefer that. And so I think it might actually come down to something like that, and they may not actually realize the tangible value. I think Anthony's example just now was perfect, of actually being able to put a number instead of saying a 0.01%, which actually sounds like nothing. Actually being able to say this could be worth X. There is obviously a danger to doing it that way as well, because it may not actually get to that X. And as you can see, even in the survey that you did, you have, I think it was roughly half of the employees that don't actually know if they're going to be able to make money with their options. So I think there is definitely an education piece, not for founders, but for employees, that is probably more important.
No, that's a great thing. And about understanding on how to present that and how to communicate to employees. You did also a survey on benefits, Virgile, with figures, and you are really insightful answers and responses. And we had also a discussion during our brief call, and you were mentioning that there is a missing piece with education, and you were maybe thinking that founders should also maybe be better on communication, to communicate what could be the upside about sharing your capital. So can you explain what you think based on also the survey you did?
So not only based on my survey, I'll go back to a personal experience of mine when I joined Criteo. While I worked for Criteo for 3 years, right? And I think it was 2015. And when I joined, immediately I had to look after, from an HR perspective, the population in Palo Alto, right? So Palo Alto, California, like the tech center of the world, right? And literally, when I went over there, I realized that an employee of Criteo, and I say a standard employee in California, is, and I'm not kidding about that, or at least at the time, was 10 times more knowledgeable about equity than half of the HR professional, and I think, honestly, 99% of employees in France, right? So why? Because basically, like, this is the heart of the tech world and has been for decades. This is where tons of companies have been created. I've had tons of success stories. I mean, how many times have you heard, or have we heard, maybe less so the people, like the story of like the Google, like the masses in Google that had like 0.001% of Google and like was millionaire. Right? So it's like actually, I'm tired of this anecdote, but the thing is, there's been so many successes over there. People know about those successes, have either benefited from like startup exit and getting cash from options, right? Or know someone who did. And so they're very knowledgeable into what it represents, what's the market standard, what it could be worth. And honestly, a lot more knowledgeable than most people I'd say, than the UK, maybe Division 2. This is what I said during our call, like, right? And then the rest of Europe might be Division 3, right? In terms of understanding about it. And it means, and the interesting things there, so it means like, honestly, I'm pretty sure, and I'm trying not to be arrogant there, but I'm pretty sure half of startup employees don't know what a stock option is, like really, right? I'd say that at least half don't understand what a stock option
like
is.
Like you said, they prefer meal voucher and they don't really understand the value and the upside from
No, they just don't understand it. And what's interesting that I see at the moment is I see more and more founders, because they're so versed in reading materials based from California, right? From all the startup ecosystem, publishing things about how equity is important, equity models, why you should do it. Themselves are very knowledgeable about shares because, as Anthony was saying it, they get a ton of shares of their own company, right? So they very much know what is a share, what is a stock option, what is a valuation, because it impacts their wealth directly. And they create all those great models about equity, right? They spend tons of hours creating equity models to grant equity to employees, which is, once again, a good thing. And they're like, okay, we're giving you this. This represents 2% fully diluted over 4-year vesting with an acceleration clause and a 1-year cliff. And people are like, yeah, what about the lunch vouchers? Am I getting them, right? So, and literally, and one interesting point is, in fact, I think some founders, I don't think it's the majority, right? Use that against employees, because when Anthony was mentioning, I'm giving you 50,000 euros of stock options. Yeah. People don't understand what is 50,000 euros of stock options.
Yeah.
And people are like, wow, I'm getting 50,000 euros of stock option. A stock option, by definition, I mean, is only worth something if the company, if you can get, it can become liquid, so exits, or you can sell some of stock option, and the company's valuation has increased, and so on. But most people don't understand that. They receive a job offer saying you're getting 50,000 euros worth of equity, and they're like, wow, that looks good, right?
Yeah, that's true.
That's the biggest issue, and I agree with Roxanne, is level of education needs to increase. It starts with companies, it starts with founders, it starts with HR people, but it also starts, and it's a very basic thing, from success stories in France. The more people benefit from getting cash out of equity, the more they will learn to value equity, and their friends that they will tell all about the equity and what they made out of a successful exit will know about equity. Yeah. It is the biggest thing is about education.
And that's really interesting because, as you said, so US Division 1, UK Division 2, and the rest of Europe, maybe France Division 3. Do you agree, Dominic, about like these, like the statement that US, maybe because of the maturity of the market, is way maybe in advance based on the success story we know and we heard, and it is a fact. Do you agree with that, or what do you think? Why there are so many differences?
Definitely, it's all linked to the density and the size of exits in a particular ecosystem. And like putting in human terms, it's how likely it is that you will have friends or family or colleagues or whatever who have either made significant amount of money from a big exit or not made significant money because they didn't have equity or they didn't have join early enough or whatever. If you're more likely to know somebody in your network who's that, then people start to sniff and they sort of realize there's something significant here and interesting, and they'll argue for it. So Silicon Valley, rest of the US, UK slightly behind rest of the US. I mean, I've created these bands before. I'd say France, Sweden, probably next band, and then probably rest of Europe. I'd probably say, to be honest, France and Sweden, maybe Netherlands, are more savvy. Germany's getting there, but it's still pretty behind. But like when you go to, if you're trying to hire, like create an engineering team in like Bulgaria or Poland or whatever, the zeros is just cash is king. They're not going to make that switch over.
Dominic, I wanted to jump on that because I find it super interesting to know that also all the European countries kind of are at different points. How do you explain why an ecosystem picks up? Why would France be ahead of Germany, for example?
When I say France ahead of Germany, in that I've got limited data, it's more qualitative and pattern recognition, and when I come to ecosystem here, I think it's largely, two factors. One, because the tax and regulatory regime of BSPCE is extremely good compared to Germany, Spain,
There is no
Netherlands,
tax advantage.
whatever.
Yeah.
It's extremely good. Other than the Baltics, it's the best there is in Europe. So I think that it makes it a real benefit that you can really sell to people. And second would be the structure of the talent in startups in France v Germany. Like French startups are extremely domestic talent focused. The vast majority of people working in startups of France are French nationals, whereas the typical Berlin startup is mostly staffed. Most of the team will be from Eastern Europe or South America, very, very few actual German nationals. And so again, if you're coming from Poland to Berlin to join the startup scene, you're more interested in the cash. So it's those two reasons.
You know when you go to a party and you buy this very expensive bottle of wine and you check the appellation and the year and you go and you give it to the host and they go, red wine, excellent. We'll put it on the table, and your heart sinks. And I think with share options with your employees, it's very much the same. And I always like to do my research for talking to people in the audience, and talking to one of the members in the audience, they were saying how the difficulty they have in their company is that the founders, the companies, are super enthusiastic by the options, and the employees, it's nice, hey, great, thanks for that. So I think we all need to work to educate the team on the value of options. And there are two parts to being able to do that successfully. One of them is to see big exits. So you see, as Dominic said, if a company sells for billions, the employees, even more junior employees, will make something significant. And then people see, oh, great, there really is some tangible benefit. And the other thing is the tax piece. So one of the hidden things is that when you give somebody share options, and I'm not sure in France, my French colleagues would know, but in the UK, when you give someone some options, there's no tax problem. When they exercise them, they'll pay a certain amount of money to get the right to buy the share, and then later on they may sell the share. Now, in the UK, when you exercise the option, you have to do this within 90 days of leaving the company. And it may cost you several £1,000s to exercise your option. And depending on how you agree a valuation with the tax authority, it could be either a small amount or a large amount. And this is one of the real problems with option schemes, because the employee, they have to write a check. They have to pay for it from their own money for something they may not be able to sell for years later. And it's this which often means employees just walk away and don't get any value from their options. So these are, again, the things you need to explain to employees and work to get the lowest possible, what's called strike or exercise price, so the employee doesn't have to be out of pocket for years with their own money, having paid for something, before they can realize the value later.
And this is really also a good example, because in the UK, you have a tax advantage scheme called the EMI, so Enterprise Management Incentives, which is the equivalent of the BSPCE we have in France, but there is still some discrepancies between the two schemes, and there is no like European playground for options and even for tech as a whole, because there is a competition between countries. This is also maybe why we maybe have a lack between like France like is less I don't know, like less keen to maybe have employees sharing the capital with founders, sorry, to share the capital with the employees. So maybe it's structural. And how do you explain, Anthony? Like in the UK, you can play with the strike price, but we do think there is like also a link between the structure with the countries, as Dominic said, with regulations. How do you explain, like, with the UK, how it works with the EMIs, you said, and compared to France and other countries?
I think the UK, you know, America's got the giant exits, where you see the multi-billion exits and you see people making lots of money. And the UK is nowhere near that, but still has some good exits, Deliveroo floated and so on, and many of their employees, even the drivers, had share options. And when people see that, it motivates them. And maybe the key is within your own company to show people what the value might be. So, for example, when you create an option scheme on SeedLegals, your employees get a login and they get their own options page, their own dashboard, and they can type in a company valuation and the system will tell them how much their options are worth, and it even subtracts the tax things to show them what the net benefit will be. And hopefully it's little things like that. You know, if the company's worth 5 million, great, I can pay for lunch. If the company exits for 500 million, oh great, this is actually quite a big amount. So it's little things like that that help the team interactively see the value. Of course, you have to be a bit careful, because if you go too far, a couple of startups ago of my own, my team said, how much are my options worth? So I said, I tell you what, I'll give you an update. But then every month they kept coming back saying, how much are my options worth? I'm going, they're no different to last month. I mean, we had a funding round and we'll have another funding round, but nothing's changed. It's not like looking on the stock market where in the newspaper or online you can see the value of a company day by day. So if you overhype it, employees are going, well, tell me, you know, what's the next board report? Is it worth 40 million or 80 million today? I have no idea. So try to keep employees engaged with the long-term gain and keep them updated and help them understand personally on a dashboard to see what it might be as things to help engage.
That's, yeah, and you said that, Dominic, that there is different regulations. You also did like a great work on the rewarding talent book with a scoring country by country. And the UK were like at the top with the French also scheme with BSPCE. And so why there is no regulations, like no same playground in Europe? Is it because, of course, it's a region by regions, because of the tax? Because I know you're working hard also on a European level, maybe to standardize the single market with options. How do you explain the tough work it is like to implement such plan?
Yeah, I mean, yeah, anything that is to do with taxes. If you told me like several years ago I'd be working with a whole range of European governments on tax policy around options, I would have probably put a gun to my head. But having said that, it's, you know, I think just feel it's a really important part of helping the European ecosystem to improve is getting, you know, I mean, if the whole of Europe had a scheme like BSPCE, it would be fantastic. I think it would be a game changer for Europe. It would make a massive difference, or even better if an EMI type of scheme was in place, is even more benefits. But it's just trying to get governments to change, and changing on tax and whatever it's a really hard sell. So we've had small victories, we have had some, but I'm not expecting I'm not expecting a harmonized single European stock options market anytime soon.
If we go like in details, like when do you implement an ESOP scheme? When do you want to share your capital? Because we've been like having a discussion on the overview, but now it's a good question. So concretely, Anthony, when should you implement your stock option plan? When is a good time? Because we
Okay.
can see, it's
So to quote BuzzFeed, here are the top 6 things to implement your share option scheme. So thing number 1, when you hire people in their employment agreement or in their contract, you can promise them some options. And so you would promise them some salary and promise some options. Thing number 2 is at some point you have to create an option pool in your company. So an option pool is the right to give people options that will convert into shares later. And a pool is just like a virtual construct. When you issue more shares in a company, you need to get shareholder resolutions because you're diluting the existing shareholders. An option pool is getting the necessary mandates or resolutions, and it will differ by country, that let you freely give options to team members. And depending on the country you're in, sometimes you need to have created this first. But creating the option pool is a bit of legal paperwork, but super easy. And the key thing you need to figure out is what size pool do you want? And there the data shows 10% option pool is the most common. Remember that when you create an option pool, it's going to dilute typically the founders beforehand, all the existing shareholders. So your investors might be pushing you to make a really big option pool, 20%, US style, but that will dilute you massively. So you may pick a 10% dilution, and then you might make a bigger option pool later on at the next funding round. And now you've got an option pool. The next thing to do is to create an option scheme. And here, hopefully on SeedLegals, we can make this much easier. You're going to create a BSPCE scheme for your employees and other schemes for contractors or non-employees or people who live in other countries, because only your local French taxpayers can get a French tax benefit if they're employees, and likewise in other countries. So that's really step 3 or 4, which is create the scheme. And lastly, you create option grants for each person, which really takes the promise you've made when you employed them. You said, hey, Bob, I'm going to give you 1,000 options. Now you do the legal paperwork that goes, here's your options that vest over a certain period, and here are the rules of the scheme, and if you leave in this period, you lose them, and if you stay for this period, you can exercise them, and so on. So these are basically the pieces to a scheme. I think there are a couple of other variables. The main ones are, how long will your options vest for? Do you have to be around for 1 year, 2 years, 3 years, 4 years? And again, 4 years is typical. 3 years, sometimes people be. So after 3 years, you've got all of them. The next thing is called a cliff, which means you can say if you leave any time in the next year, you lose everything. So this is often used with founders because many times they're founder fallouts. So you don't want a founder to leave and keep their shares, or you don't want an employee to join you, stay with you 2 months, it didn't work out, and now they're forever, a shareholder. So it's kind of double or quits. If you're with us for this time, you get your options. Before, you get nothing. So the 12-month cliff is fairly common. And then the last thing is when you let people exercise their options. So an option is just a right. Hey, I'm giving you the right to buy 1,000 shares at 1 cent per share. Later on, the person gives you 1 cent per share, and you give them the shares, which are now worth €1 each, and they may sell them later. But people, you don't want your team members coming to you every month, hey, can I exercise another 58 shares, please? It will drive you crazy. So what you might do is you might say, you can only exercise your options each January so that everyone decides what to do each January and they don't hassle you during the year. Or you might say you can only exercise them when you leave the company so you don't have employees who are shareholders, and that might mean you have to give them shareholder updates, which might be confidential. Here's my salary banding for next year. Oh, I didn't mean to share it with you. Or you might even say, you can only exercise them when we sell the company, so I don't have any employee shareholders until an exit. So these are the variables you can play with. And what we've tried to do is, it's kind of complicated, and there are a few variables. We've tried to sort of simplify it so you can easily pick the ones that work for you. A bit like, ordering a car. I'm going to have it in green with 4 doors and one of these lights, and you put it together and you've got your custom car. but actually there are only a few choices to make, and most people get it this color.
Thank you, Anthony. That's really interesting. And then it comes to how to communicate with your team about the scheme, how to explain how it works. But first, we have to excuse you, Roxanne, because you have to
thanks,
leave.
guys.
Thank you very much for being here. We can applaud. Thank you very much. For being here. Bye. And so, yeah, when it comes to communication, because you have set the rules, as you said, Anthony, with like typical vesting condition. Okay, 4 years vesting is usually super common. And then it comes to how to communicate. We had really, yeah, of course. So we had a really good insight from the survey, because like most of the companies, they explain how it works during their onboarding. So it was really interesting, like to hear from you, Virgile. How would you communicate with your team? What would be the best way to communicate with your team, because it's really part of the culture of the company, also the plan.
Yeah, so as you say, it's really important to communicate, because I think there's two options if we discuss more for founders. When it comes to equity, if you want to go like all in on equity, give equity to everyone, you have to be super strong on communication. In fact, I've seen on the many companies I've worked with, mostly in France, over the past year or 2 years or so, because of the bias I was telling you about before, like the founders are super knowledgeable about equity, do a great model, gives a ton of equity to everyone, but then no one understands what it is. So if you want to be strong on equity, you have to be strong on equity, modeling, like the conditions you talked about, and communication. If not, then you end up in a situation where you give a lot of equity, you give a lot of your capital as a founder, and no one understands it, right? So as you say, really, it's super important. So, and in fact, I used to tell founders, it's not my belief on equity, right? I have a strong stance on giving equity to everyone, which is what we do at Figures, by the way. But I tell founders, either you're all in, meaning giving equity and communicating very well.
Full transparency?
We're full transparency, and that's another discussion to have, I think, full transparency. But either you're all in on equity and on communication, either, you know what, you might be very cautious with the model and only give a few grants to a few key people, if not. And I think this is, in terms of pure return of investment, those are the two approaches. And I see often founders falling in the middle, in the sense that they give a lot of equity, don't communicate, so it's wasted. It's like literally wasted. This is a bottle of wine you are discussing about. So communication, to get back on your question, it starts at hire. When you send out an offer letter, what supporting documents do you provide the candidates to understand the equity? And you know what? In fact, up to very recently, there was very little article in French explaining what the BSPC, a stock option, was in France. Very good one. Very few good ones, sorry. There was an article by Jean de la Roche-Brochard from Kima Ventures. That was not too bad. And I think recently, like a year and a half ago, there was an article on Madines from someone from Malta. I think that's the best one, like, I think, too far. You did one that was good, in fact, a while ago. But just the fact that when you send out an offer letter, you're like, to understand the equity I'm giving you, just go read this article. One good thing. Second thing, how do they model the equity, what it could be worth, right? You need to provide employees ways to simulate what could my equity be worth in the future at hire. And you need to run it through them, like, this is how it works, this is a stock option, this is our current valuation, this is what it could be worth in the future. And same thing here, in terms of purely French literature, there hasn't been a ton of models out there to help employees understand what equity is worth.
We will do so. That's a good input. Yeah, and this is really like, the way to explain to people is like to give articles, to give some resources, because you have to help them to understand what it is, as you said.
Yeah, and they have, so as a founder, you have to, at hire, what documents and what information do I provide people to understand equity? And then you just to regularly update people about it, right? So when I was in Comet, we were giving up a ton. In fact, before I arrived, the founders has this vision that equity is super important to make everyone a potential shareholder of the company, to align interests. Everyone's part of the adventure. Everyone has potential shares of the company, right? They were giving quite a lot of equity. They were doing something very cool that I encourage a lot of founders to do. They were also offering employees a choice when they arrive between more or less cash and more or less equity, which I think is a very important thing, which is a very cool thing to do.
But they have to understand.
But they have to understand. And exactly my point. Most of them were making choices they don't fully understand. And then after, when I arrived, I realized that mostly no one understood equity once again. So I run regular session, I'd say at least every 6 to 9 months. What is compensation? What is equity? What is equity in our company? And let's run example. And every 9 months, it was a bit frustrating to me, but you had to keep repeating it because people, it was tricky. It's tricky to understand for people how stock option works, how valuation works, how dilution works, how liquidity works, so when can I exercise my share. This is a tricky topic. So you need to repeat it often. And to be honest, as we said multiple times, I think now, the more success stories there will be in France, the more people will realize the value of equity, and the more people will want to understand it, right? When it's all theoretical, we're not sure it might be worth something, I don't understand, it's tricky to understand, people can switch off. The more people will realize what it could be worth, the more people will have interest to understand what it could be, and then we'll go back to what I was saying about California, right? When I went over there and all people were like, okay, projections over 4 years of their own equity and understanding dilution and so on, but to get there, people need to educate themselves. We need to produce, as the ecosystem needs to produce good resources for employees to understand, and founders, it starts with founders, needs to be super strong into communicate early and higher and communicate often during the life of an employee and the life of a company. If they don't do it at least yearly, they're failing. At least yearly, I guarantee that most of the people within their company don't understand what they have, at the very least.
And then we will have concrete examples with the maturity of the market, with big exits. Hopefully, we will see this be concrete and have the upside. And Dominic, on communication, I know this is you're working on it, and this is something you mentioned in your book, in Rewarding Talent, that it is super important to communicate, like Virgile said, about your plan. What will be your do and don't on communication to explain to the audience how to do that with a startup and their employees?
I mean, I think Virgile's talked, he's outlined a lot of the key things. I'd definitely be saying more than once per year. I agree with the in or out thing. I think giving to everybody, giving something to everybody, I always say part of the benefit is, to me, it's part of, for the first 100 employees or 150 employees, our perspective is like we encourage founders to give something to everybody, no matter how junior or what role they're in that it creates that startup vibe, that alignment. But the other benefit that comes out of it, it gives you an opportunity as a founder to repeat that message in more situations, right? If you're only giving equity stock options to some portion of your team, then you have to carve out those people. It's a them and us, and you have to find an opportunity to talk to just this group of people or one-on-one, which is both culturally can be awkward and isn't really the sort of vibe, the sort of classic startup vibe, and it's also makes it much harder to make those moments happen. You can't celebrate as a whole team if there's a significant fundraise, or those sort of to sort of treat everybody as an owner and everybody's actually got some sort of stake in the company. So I think those tie in with the communication things, that and just saying giving grants to everybody gives you more opportunities for that communication to happen, I'd say. The other point I'd say, just it's not quite communication, but it starts with a C as well, so I'm going to say consistency. And to me, communication is key, and I think consistency is key. And this would be advice, just anything you do in terms of compensation for team members. This isn't saying you should be fully transparent with all pay and option grants and whatever else. Although I would say that I hear more founders in Paris pro total transparency than I have anywhere else in the world. It seems to be a real thing in the French ecosystem. But setting that to one side, I always say any team member, whatever you pay them, cash, equity, whatever deal, whatever happens, you should always you should never feel nervous if everybody else did know if every team member knew what every other team member had as a compensation package. You shouldn't be uncomfortable with that. You should feel you can justify and there's a strong rationale for why person X has got this much, person Y has got that much, which is why, always we push the idea of having a set grid, like how much you get that is clear, is consistent, so that you're not, it's too easy as a founder to, if somebody pushes you when you're hiring them, that you go outside of the grid, that you give them a better deal than the next person. And that's both unfair, it's also, you can hit real diversity issues there, like certain people or types of individuals might be more likely to push much harder, and then they're earning more. So there's a fairness and equity issue in there. And also there's, look, you're giving equity, right? When it coming down back to stock options, right, as part of compensation. It's the most valuable asset you have as an early stage founder, right? The most valuable thing. You don't have many customers, if any, yet. Your product's really basic. The most valuable thing that you have is giving up equity, right? So if you're going to give it up, you want to make sure it's going to have a really strong motivating effect, allow you to hire and retain people you wouldn't have. If somebody finds out, even if you gave generous grants, if two software engineers find out, oh, the person sitting next to me has got twice as many stock options as I do, but we're doing the same role, that person might still have a really good chunk of equity, a really nice grant. How are they going to feel? Are they going to feel positive about that or negative? They're going to feel really pissed off. So you've just given up a chunk of equity in your business, and it's created a demotivating effect. So it's totally the opposite of what you want. So I always say, be absolutely consistent and rational in the way you treat these, and that's why I say set up a grid system. If you're in this function, this level, this is what you get. You might have an extra, like you can trade off cash for equity. You might have some trade-off things where you can shape the offer, but you should always be driven by formulae. Don't be driven by personalities. It's absolutely wrong on every level, ethical and also rational.
So welcome to the joys of being a startup founder.
Yeah.
And you think the problems you've got actually are legal problems and documents. And actually my goal at SeedLegals is to make that all super easy so that you can focus on the really hard problems, like the game theory of how to motivate your team. So when you start the business, it's only like 3 people, so you're never going to have salary bands and so on. But I learned when I was at the BBC that the BBC had this immensely complicated salary banding system, and one of the developers would come to me and said, can I get a salary increase? And I'd go talk to HR, and they said, well, HR says you're a level 3, 5-year Java developer, therefore you're getting between this and this in year 1, and it was insanely compartmentalized. And it left no freedom, and I've never really been keen with that. But as our own business has grown, it's become apparent that these banding things make sense, so that you're not having everyone, on a whiteboard listing everyone's salary, which is a bit too open, but everyone might see that, oh, I'm in this group, and therefore in this group it's these bands. And I think that makes sense with salaries. But now when it comes to options, we've heard there are 2 ways to go. You can either give options to everybody, or you might give a lot more options to a few people. And this is a really fascinating problem to solve, is if options are there to retain the best people and the most valuable people in the business, maybe you shouldn't give it to everyone. You should give it to a few people to really motivate them. And maybe you're saving 120,000 euros a year to secure this tech lead you wouldn't otherwise be able to get, but in order to do that, you had to give them a huge chunk of equity, which you couldn't do if you gave it everywhere. Or should you maybe more democratize things and make a team vibe and a culture? And I don't know the answer. And at SeedLegals, actually between myself and my co-founder, we have slightly different views. I'm the much more democratize everything, and he's much more, let's pick key hires who we really need and use it. And we've evolved what we do with time, so really now everyone gets. So these are the fascinating things that you need to think through, and maybe like a multi-step game of chess. What are we going to do this year? And then if we keep giving this number of options, we're going to run out of them by year 2 or year 3. What are we going to do next? So, you can also hit us up on SeedLegals and chat to us, and we're delighted to brainstorm these with you as well.
I would just say a little, just building on that, because to get out of the theoretical as well, because you're absolutely right. SeedLegals has got fantastic resources on this. I'm going to do one plug for the index tool that we have as well, which is called Option Plan. So if you go optionplan.com, and we've got different levels. You've got a seed version and a venture version, and you've got a very basic grid, and it tells you what the sort of benchmarks are. And if you want to aim for high for Europe, low for US, high for US, it tells you the different benchmarks and what grants should be for technical people, non-technical, senior, junior. It provides all of that and what that would turn into in terms of a actual dollar value of a grant. So just to get out of the theoretical into when we say be consistent, like that is what we would be proposing. And I've recently updated the data and the benchmarks in there just 2 or 3 months ago. So it's like very up to date with what we'd be recommending, right? So that's why a little mini pitch for what resources
really good tool to use and really insightful. And also we spoke about communication, but what could be also good effects to motivate people could be like how to monetize your options. Maybe secondary could be a good way to motivate people, because it becomes like something theoretical to something concrete. And you also mentioned that in your book, Dominic, about secondaries and the effects. So can you tell us a bit more about how to motivate people thanks to monetization and secondaries?
Yeah, I mean, this is later on, right, in the journey, okay? But it is really important. What Florent's talking about is you sit, if you join most of you obviously going to be super early stage founders. If you build an incredibly successful business, I think you'll be aware, right? The journey from seed to IPO is like approaching like 10 years. So it's an extremely long time. So if your liquidity event, the point at which your options can actually turn into real cash, might be 10 years, that's a hell of a long time to wait. So we've talked about what the impact is on terms of how you treat levers, etc. But what about the people who stay on, who do stay with or are through, are they going to be waiting that 10 years? In 10 years, you might have settled down, had children, bought a house. You might have some big impact things on your life where you could really do with some liquidity. And so what employee secondary means is being able to sell some of your existing shares or options and trade them in, selling them to investors generally. So if you've got a company that's doing very well, you're fundraising, especially in this environment. If you're doing really well, there's a lot of funding around. If you've got more investor demand than you have that you're trying to raise, you can offer to actually a portion of vested equity can be sold to those investors, so that it gives an opportunity for monetizing stock options before you have a final exit. I think it's a really, really powerful motivator. Founders have been doing it for a while, but now we very much encourage schemes which are opened up broader to all employees, not just to founders. Give other employees that opportunity. So we're very much in favor of that. But the way you do that, making it structured or ad hoc, it's usually attached to a fundraise. So if you have a fundraise, you've got excess investor demand, you can then ask employees, perhaps only employees who are fully vested, or only employees who've been with you for a certain amount of time. But do you want to trade up maybe up to 20%, 25% of your options? Do you want to be able to sell them now to make some cash? Really motivating, and much more motivating than things like refresher schemes, etc. as well. So we're seeing more companies doing this, more companies doing it earlier, more companies opening it up, doing secondary to broader employee bases, and doing it in a more regular, structured way. But this is only from the very earliest you might see this is a Series B.
Yeah.
Exactly. So it's several years down the line, but it's worth bearing in mind.
So we thank you, Dominic. We had a really good chat on how to implement, why to implement such like policy to share your capital with your team from the beginning to maybe monetization thanks to secondary. Usually it's through an exit. So thank you very much for this chat. But before we leave and we have your questions from the audience, what would be your 3 takeaways for the audience on how to implement a scheme, how to share your capital? So maybe to start with you, Virgile, what will be your 3?
So do I need to give 3 or it's like 1 per person?
No, it's a 3, or you can take 2 or 1 or whatever.
I'll just get
take
1.
some-
I
yeah,
just
some
we just
takeaways.
focus on what I was saying earlier on is just education, right? So I'd say founders think about how you're educating your employees and your candidates about equity, and let me tell you, you're not doing it enough. Like 99% of founders are not communicating and educating enough. That's a fact. So founders, that's my advice. And you know what's my advice to employees and candidates? It's the same thing. Find out the best resources, educate yourself, know what you can ask, know what you, and it might be tied to questions we've had and we might have, but know what's market standard, find out how equity work, find out the good questions to ask. To me, the whole thing is about education. So people getting educated on the topic.
That's great. Great takeaway. And from you, Anthony?
Great point. So I'm wondering, actually, maybe I need to do this myself, which is, as a product guy or as a founder, you're always familiar with product market fit, talking to customers. Maybe ask your team, what do you know about share options? If I were to give you 20,000 euros in share options, do you think that's a good or a bad amount? So you might do a bit of research with your team, and maybe you'll discover some interesting things that help you then know what to do next. So a bit of testing. The next thing, of course, is my goal on SeedLegals is to make it super easy to actually create these schemes and create these promises and help the team understand how much they're getting. So please do your scheme on SeedLegals. And then the third one is really about the communication. And I think there it's quite fascinating because I love the idea of, inspiring, hey, we're worth 100 million and your options are worth this amount. But it seems kind of weird as a founder to be doing that. And I have the same problem myself. I'd love to do that with a team, but on the other hand, to start saying what your valuation is, it seems a bit kind of, my mission isn't to have a valuation. My mission is to, deliver a product that consumers love. So it seems to change the tone of everything in a bit more US-centric way than I'm quite comfortable with. But anyway, everyone will find their own formula there between I'm not mentioning it at all, so nobody has any value, versus I'm hyping it so much each week that please leave me alone. This is not Bitcoin updates every day. So, yeah.
Thank you, Anthony. And Dominic, what would be your takeaway to the audience?
Look, I totally agree with both the points made. Communication and education is critical. I'm going to be, sort of linked to like the first example I gave. So this is the sort of, said a lot around like consistency and fairness and how important those are. So I'm going to go a little bit more red meat and say, think about how you can really leverage your equity and the use of stock options to really build the absolutely feckin' best team that you can, right? How can you aim super high on the people you're going to hire and using equity, like the sort of example I gave, to be able to use equity to make hires that you wouldn't otherwise have been able to make, to bring in talent and a caliber and quality of individual into the team that's going to totally change your trajectory, and really think about how you can do that, and not sort of what's the minimum I can pay to bring in somebody to do this job. It's what's the maximum game-changing individual I can bring in, and what's, and using the equity to secure that. I think thinking of it in that really ambitious way, I've seen it work so many times at various different stages, and particularly thinking about if you're a founding team, right? What are the gaps in yourselves as a founding team, right? And then how do you ensure, like maybe you don't have a technical co-founder, or you don't have somebody who's much more commercially minded, whatever, but think about how you can bring in somebody. You're too late to bring in another co-founder, but then how can you have that game-changing thing? Or on your early engineers or whatever. but really use it to unlock access to talent that wouldn't otherwise be there.
Many thanks. Thank you, Dominic. Thank you, Anthony. Thank you, Virgile. So we can maybe you can ask your questions. So if you have any questions, please do so.
Did we answer your question about the details, or would you like more detail on tell me the 5 things I need to do tomorrow?
Thanks, Anthony. So it's actually interesting. So I swear I'm not like dodging the questions, right? But when it comes to benchmark, there's actually good, very good articles on like founders. I often get the questions like, how do we split shares as founders? There's at least compiled like 7 or 8 models and articles about how do we split shares as founders. And it's not always 50-50 or 1/3, 1/3, 1/3. There's tons of good articles about seed and above models. And in fact, the best one is, and I'm not saying this because he's here, but optionsplan.com and Rewarding Talents is a Bible on what's market standard. For pre-seed, actually, so I'm going to punt this to someone else. I get the question, I haven't found reliable standard market practices for pre-seed grants, which seems to be a bit of a dark area. So I'm sorry I'm not dodging the question, right? But I actually don't have like good resources for pre-seed benchmark. But like Dom will have it, right? So Dom, of course.
I don't use benchmarks for thinking about pre-seed. In our book, in the Rewarding Talent book, which Index has, we have a section on this, which actually I effectively co-wrote it with the family in Paris for how to think about pre-seed equity awards. And it's really a sort of formula based on like sweat equity. So, because often if you're pre-seed and you haven't got funding, you're paying virtually nothing. You're paying way below market value for somebody. They're probably not, they might not be an employee, they might be contracting or whatever. So think of it in terms of like, you have to come up with a notional valuation for your company. So it might be, 2 or 3 million euros, like as a pre-seed valuation. Again, this is very much art, not science. But maybe 2 or 3 million, and then what's the deficit in the day rate that you're paying equivalent for that person? And then if they've been working for 6 months, let's say free, that might be equivalent to 40,000 euros of salary. If your pre-seed was like 2 million, 40,000, 400,000, you've got you've got then like 1% equity they might have earned or whatever. I'm not going to try and do the maths in my head here, but it's idea of like sweat equity, and that was the closest I could get, because I really thought long and hard about how to do this effectively, and it was work out what effectively that person has earned in value of equity for the salary that they're not getting, or that they're getting massively discounted.
And that's exactly my advice, because one of the problems is particularly sometimes employees, but often advisors. So you want in your pitch deck, you want some advisors or people are directors and they want some options or some shares. And then they say, I'd like 10% or 1% or 5%. What's the right number? I mean, it's all arbitrary. So to equate it to a euro value is quite useful. And you say, my company valuation is €1 million, so 1% is 10,000 euros. If you would like to be an advisor coming in for a day a month to advise me, and you're asking for, well, let's say 10,000 euros a year, maybe okay for that, maybe 10,000 euros over 2 years. So I'll give you 1% equity vesting over 2 years. That's the 10,000 euro equivalent. And now you've picked a sensible number and you can explain the number to the person. So if they go, actually, I wanted 8%, you go, crazy, that's 80,000 euros for coming in 1 day a year. I can hire a developer or 2 developers and give them some options. So equate it to a cash value based on a notional valuation, and that makes the explanation in the early days much easier.
Is it clear? And then for the conditions, if you think about the conditions of the grant, as we said, like it could be like standard with 4 years vesting, with 1 year cliff and so on. So You can have a look because we will share the survey and the results, so you will all receive the results of the study. And of course, you have some resources with the book Rewarding Talent. We have also many resources on our blog, so of course, go and get some info from here. Any other questions? Yes?
Thank you. So my question was, yes, that there will be vesting, yes, there will be all of that, but do you? I mean, you people must know, but like, in the startups that has any of these startups divided up shares into like different classes to then provide non-voting, voting, preference, all of those different kinds of shares for I don't know, employees, different classes for employees, different classes for advisors. Do you have any idea on how that goes?
This is a good question because for shares you have like ordinary shares and you also have like preferred shares with different rights attached to the shares. So who would like to respond to the question?
You should, Florent, in the French context.
Yeah, but in the French context, of course we do have ordinary shares, so it's usually only like the same shares as the founders. So you do not have like preferred shares that the investors, for instance. If you do a seed round, you will have with business angels only ordinary shares. You don't usually attach like preferred shares on top of these ordinary shares. And then when it comes to like VC round, usually you negotiate in your term sheets preferred shares and with like all the rights attached with like liquidation preference, anti-dilution and so on. And it's based on your term sheet and then on your shareholders agreement. But when you share your capital with your team, you usually give ordinary shares, so it will be you have the right to buy ordinary shares thanks to your BSPCE. And yeah, so, but this is something different in the UK because in the UK, Anthony can explain that, you have also what we call B, non-voting rights. So
yeah, so you've got one of my pet subjects. So the problem is many startup founders look at Mr. Zuckerberg and they see, Mr. Zuckerberg's got these special super voting shares. So that when they incorporate their company, they want to give themselves super voting shares. And it's a disaster. 100% of the time we see people do it, they have to unwind it because when they meet investors later, the investors go, this is the opposite. You shouldn't have super voting shares. We should have extra voting. So thing one is founders start with ordinary shares. And later on, when you have a funding round and you have a VC, they might want preference shares. But when you give your employees share options, you might give them options that convert into ordinary shares. I don't know about France, but in the UK, if you give them non-voting shares, you can get a better tax deduction on the valuation. So the employee has to pay less for their option. So there's an advantage, which is a seminar on its own. So typically ordinary shares for founders, maybe non-voting shares for employees, and either ordinary or preference shares for investors, depending on what they require.
thank you.
I had a follow-up question, if it doesn't bother
Yes,
you.
please.
So the thing is, regarding, let's say, wait, I forgot my question, so I'll come back to you.
No.
Okay.
Any other questions? No? No other questions? So I think we're okay. We can have another questions. Maybe the last one, and then we can have a discussion because we do not have a networking drink afterwards, but we have a space booked in the bar next to Station F, the Odeon, so we can walk there and have follow-up discussion and networking drinks. So maybe the last question, yes, and then.
Yeah. Well, yeah. Do you have an idea how many employee doesn't exist the BSPC at the end?
Really good question because how many employees do not exercise their BSPCE at the end? We have like these numbers usually is like close to 90%. So like most of the employees do not exercise their BSPCE either because they're still in the company, they do not have also like a counterpart keen to buy the share, so no liquidity. So it's either because they're still in the company or they do not have like the opportunity to sell the shares. So usually it's like 90% of the employees that do not exercise their BSPCE.
90.
I'd say it depends very much on what your levers policies have been,
Yes,
right?
also, yeah.
You know, because the vast majority, you know, I've been doing some analysis, not specifically on this, but yeah, if you look at a company by the time it's IPO'd, it might, at the point of IPO, have 1,500 employees. But if you look at every person they've ever employed, it's going to be more, it will already be more like 5,000, right? So, yeah, just, you know, we said before, does everybody get something, whatever, but just using those ratios, the large majority of people at the point of exit will not, the large majority of employees who had options will have left. So it really comes down to your policies on levers. So I suppose that would be one of my bits of advice I didn't say earlier, but there's too many bits of advice. But I sort of think, you know, I know we're very supportive of being very generous to leavers, to departing employees. You know, and it's partly because of this reason of the large majority of people who contributed to the journey won't be there by the point of a big exit. They'll have left, and not necessarily left for a bad reason. It could be a good reason, right? You know, the generalist, you know, Swiss Army knives that you have at the beginning, the early employees are not the people you need later on when you need super specialist roles and things. It might be the right thing for the company, the right thing per person, but they still contributed to their success. So very much comes down to your levers policies. So some companies have options where you hold on to, you retain options after you leave, but you can't exercise them until an exit. So then anybody who's got vested options benefits. That's one extreme of being very generous. Or you have the, you know, if you're not with the company at the point of exit, you don't get anything. So that's like the other extreme of being very tough. And then you've got lots of things in between, right? So you can have policies. You find that I've worked on policies where there's like a capped upside. If you leave the company, it freezes the valuation at that point in time that you could benefit from. So if the valuation, you were there, the latest valuation when you left was 100 million. If the company then exits at $1 billion, you only get proceeds up to 100 million, which is the fairest, but you can't do that with tax schemes and things always. You can only do that if it's a very like virtual scheme or whatever. So there's different approaches to this, but I'd say that's the biggest factor to answer your question. How many people will exercise or whatever? If people have to put a big amount of money on the table when they leave, they probably won't unless they're very senior and they're very wealthy. And that's part of the diversity, equality aspect of this as well.
Thank you very much, Dominic. Thank you all, and thank you for being here despite the context. So thanks again. We will have the networking drinks to the Odeon, the bar next to Station, as I said. So thank you again, and thank you guys.
Thank you.
Thank you.